There we go. Welcome, everybody. It's Tuesday evening, 7 o'clock, and welcome to the Lincoln Property and Mortgage Show with me, Michael Hollenby from Hollenby Mackay Bespoke, and Jenny Holt from the Mortgage Hub. Great to be with you again this evening. As always, we always say if you're watching this live, please give us the thumbs up, give us a like, let us all know that you're out there watching us. And if you've got any comments, as always, please pop those down in the little poster comment box down on the right corner there, and give us your name so that we can make sure that we come back to you and involve you in the show as well. So, Jen, if you tell us a little bit about what's coming up in tonight's show, and then we'll hit the trailer.
So for me tonight, I'm looking at there's whispers in the industry. It's sort of over the news a little bit about these 1% mortgages and why I don't think they're possibly the right thing for many people. So I am expecting a bit of backlash, if I'm honest, and I welcome that because everyone's opinions count. So we shall see how that goes.
Excellent. Good topic. And I'm going to be talking to you about what's happening, what's really happening in the Lincoln property market in the month of January as we go into 2024. So some great subjects there. So if we roll the credits and we'll get cracked on. Look at that, Jenny. We've already got 6 people watching us this evening now. All eyes on.
Right.
So, are you all right if we start with you this week, Jenny?
100%. Yeah, absolutely. So, as I say, it's all about this whispers of the 1%. Now, I'm not a cynic or anything, but it is election year and I'm not anti government in any way. But let's be fair, I possibly think these whispers of the 1% mortgages coming out may be a little bit of a ploy to get some votes, shall we say. But we need to look at the long term impact of having a 1% mortgage. So, in essence, what we're hearing in the industry is if you buy your home with 1%, the lender will then guarantee this. So the government will then guarantee this to the lender, a bit like they did in COVID when they offered the 5% guarantee. But this time it's only 1%. Look, there is pros and cons to everything. And I think the biggest thing that I will see is when you are in the renter's trap or you're stuck at home and you are really trying to save and you can't, you put your rose tinted glasses on, you fall in love with the property, you hear you only need 1% deposit, you can afford the monthly payments, and everything else kind of goes out the window and is forgotten about. So what I want to do tonight is I want you to take off those rose tinted glasses. I'm going to give you a couple of facts because yes, at the end of the day, with a 1% mortgage, you will buy a home. But let's look at behind that and actually what could potentially that mean for you. So the first thing is you will probably need a higher than average credit score and credit profile. Now, in COVID, we have seen lots of people get a few missed payments here and there with maybe a default or a CCJ when previously they've had a clean credit. And now nothing's been sent out that how this 1% will look, this 1% mortgage will look, but I do believe you're probably going to need above average credit profile, which means a lot of people are going to be knocked out purely based on that factor. Okay, life gets in the way sometimes. You miss a payment, it's a late payment, but I think that wholeheartedly could stop you securing one of these mortgages. The second thing to consider is you're probably going to pay a higher interest rate. At the end of the day, it's a higher risk for a lender. So therefore, they are going to put that risk back on you by having a higher interest rate, which means a higher monthly payment, which then means it's going to be less affordable for the masses because the higher the monthly payment, the lesser lender is going to consider lending to you. We saw this when they brought out the 100% mortgages. When they brought these out, the interest rate was significantly higher than if you could scrape together a 5%. And I can't see it being any different this time with the 1% mortgage. The next thing to consider is the income cap. So lenders do use an income multiplier, and I get people say to me, is it only 3 times your income plus a third like it used to be in the old days? And if I'm honest, it raises anywhere from 4 times your income up to 7-8 times your income, and that will depend on your individual circumstances, your credit file, your income, whether it's a remortgage, whether you're looking to borrow more, looking to purchase. So you'll have all of these factors. But when it comes to these 1% mortgages, I think you'll be lucky if you get 4.5 times your income. So again, if you're living in a very expensive area, you may find that actually the affordability is no longer there for you, and you can't secure a home in the area that you're looking to buy. And then the final thing to consider is a change in the market. Now, we've seen over the last couple of years, there has been really big changes in the market with COVID years, house prices going through the roof, everyone earning lots of lovely equity, but then they're starting to come back down, and they've come down a little bit further and they go up. If there's the slightest change in the housing market, then potentially you could find yourself in negative equity quite quickly. So this means you could be trapped in your home, not being able to move because you can't secure it. You can't get enough money to pay off the mortgage, or you're stuck on a variable rate because there isn't the equity in there to be able to remortgage. Actually, quite quickly, you can find yourself in a bit of a dire situation if the markets did change. That all being said, at the end of the day, if you do buy a property with a 1% mortgage, the bonus to it is you own your own home. And that's, I think, lots of people dream of this. Now, I compare this to a little bit, I've got a bit of an issue with the Help to Buy scheme as well. And thousands of people did it, and it went on for years and everyone loved it. But then we roll 5 years on, and I speak to many clients who have been stuck with the Help to Buy. They can't afford to remortgage to repay the Help to Buy. If they move home, they almost feel like they're starting over again because they've got to pay so much back to the government. Or worst case scenario, they're paying a monthly payment that is purely based on the RPI, so the retail price index, which has no cap, so it can go up and up. And with the Help to Buy scheme, if anyone's not aware, the 20% or however much you lend is based on the property value at the time. So as your property value increases, the amount that you owe to the government also increases, which means that monthly payment will continue to rise, and there is no cap on that. Now, that's a major bugbear of mine, and I do think the government should step in, but we've got a whole generation that are potentially in this Help to Buy trap. Now, Mike, I'm going to ask you a question. Sorry to put you on the spot here.
No, go for it.
If you had 2 first-time buyers coming to view one of your properties, one of them had a 5% deposit, one of them had a 1% deposit, exactly the same situation, first-time buyers, same offer and everything, which would you be advising your client to take? The person with the 1% deposit or 5%?
Very good question. So this does happen when we look at potential people who are interested. And obviously you've touched on something there that it's an agent's responsibility to also verify the funding of the purchaser. So we would always be asking for verification of the funds and where they're coming from, so that when you're presenting that to your home seller, you are not just sort of, being just provided by basic data. You've got to be able to substantiate that. So the ultimate answer will always be it is the home seller's decision on which one they go with, but it's the agent's responsibility to fairly present both scenarios to the client. So we've talked in the past about obviously the offer. So if we're going to say, apples are apples, it's the same offer, and you're looking at the financial capability, the other thing then to take into account is the timescales as well, because there could be somebody in rented who's still got another 2-3 months to go on. So there's maybe another factor in there. But if we're looking at just in regard to the funding, you could argue that the person with the higher deposit coming forward has more financial sustainability, has been in a better position financially moving up to the point of offering with their savings, etc. And it could be deemed that they are a little bit more financially sound rather than somebody on a much lower deposit scheme basis. It's the same to be said, Jenny, if somebody's coming in with a 5% deposit, but even if we go back 3-4 years ago, 5% weren't around very often. It was a 10% you needed. Even coming out of COVID, it was a 10% deposit. It was what we were looking at. I remember when the Coventry brought out the 5%, all of a sudden that was a bit of a game changer. It's going back a few years there. Somebody's given a like on that one and a love heart on that. We were seeing, people having to come in with a minimum of 10%. So that probably restricted the market to people who were selling properties who'd got bigger equity in their home.
Yeah, absolutely.
It, so even if we're looking at now somebody with a 1%, 5%, 10%, or even a greater deposit of 15 to 20% with equity from a sale of a property, the homeowner naturally is going to look at somebody who is in a better financial position. So typical estate agency waffly answer, 5% over 1% is what an agent would be advising their client to seriously consider.
Absolutely. And I think you're right. Look, whether it's right or wrong, whether people should do it in that way, it's like anything. You go for a job interview and you've got two people exactly the same. You have to find that one difference and that one safety net. And when it comes to it, honestly, a lot of people will look at the deposit and think, well, if it's down valued a little bit, they've got a bit more wiggle room, or actually they've obviously saved, so they might be in a better financial position. So if you can save that 5%, I promise you, your future self will really thank you for it,
Yeah.
because it will put you in a better financial position long term. You've already got more equity, but there is that balance. And I totally appreciate some people just want to get out of the rental trap. They just need to buy their own home. And maybe the 1% mortgages will be great for them. But I would say, if you've got the money, you've got the capability to save, maybe saving for an extra 6 months, a year, whatever it is, to get that 5%. I think that will do you better long term than jumping on this 1% with your rose tinted glasses. So look, I'm open to all your opinions on this, because I know it can be quite a bit of a sore subject, especially those that are in the rental trap. So look, feel free to comment. I am ready and waiting to hear what you all think about potentially this 1% deposit the government may be bringing out.
Well, let's just give people a few moments that if they want to jump on there. Again, we've got plenty of people looking, and we've got some interaction on the show as
Mhm.
well tonight. While we're doing that, I'll just chip in a little bit, Jenny. Is that we've both been doing this long enough to know that history gives an indication of the future.
Mhm.
So, when we look at things where, you touched on negative equity earlier, in the 80s and the 90s, where, the market was very different, and all of a sudden we're overstretching on 100% mortgages, even
Mhm.
more with that because the equity of the value. So for those, we appreciate, probably most people know what this is, but capital growth and equity in the property is you buy it at 200,000 and 3 years down the line, it's worth, 250,000. You buy something at 300, it's worth 380,000.
Yeah.
That's the equity in the property. What did happen though when we had the crashes is, obviously, if you bought something at 200 and all of a sudden it's worth 150, that's your negative equity. You're stuck.
Yeah.
So, we've seen historically, and probably three crashes, two big crashes and one a decline in the market in values. We know that the people who overstretch themselves with 100% mortgages, 1% mortgages, those sorts of people were caught in that financial difficulty and trap moving forward. And it could have taken them a long, 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 long time. And going back to the 80s and the 90s again, when it was, the Conservatives and Thatcher about getting out council houses and owning your own property at whatever
Mhm.
cost, it's a similar conversation, really, where people are now in a rental market and want to move into their own home. And the temptation is I can afford it. You can afford it, but is it sensible borrowing? Is it sensible in where you're going to be in the next 3 to 5 years? Because, like you say, put yourself if where we were in 2019 to where we are now, and see what's happened in that period of time in such a short, condensed in property and mortgage market terms. That's a really short period. So it is getting sensible advice from a sensible broker, and again talking to agents about where they see the
Mhm.
hotspots are in which areas have seen a bigger increase in value. There's plenty of platforms out there. Rightmove and Zoopla do a great platform where you can go in and have a look at previous prices and things. So there's no excuse now for not having data when you're going in. But I think we've not had any questions in it, so I think you've got a way there. But
Yes.
no, I think, like you say, Jenny, it all comes down to sensibility and giving best advice, and then the client has to make their own decision.
That's it. Ultimately, it will always be the client's decision. And just touching on that as well, I do speak to lots of clients who took those 102% mortgages. I was one of them. I'm not going to lie. My first mortgage was 102% mortgage, because I borrowed the money to pay for the stamp duty and also the solicitor fees.
Yeah.
So I was that person, okay? But I am still dealing with clients who are in their 50s and their 60s, looking to repay those and really struggling to do that because of their circumstances and because they got trapped in that rut. So look, I'm not saying that they're bad for everyone and that they're devil, but I do think people need to really consider before they just think, I want that home and I will get it at all costs. So I think just be cautious if you're going to go down that route, I guess, is what I'm saying.
Spot on. I think that's really sound advice. So thank you for that. And again, if you're watching this show back or later this evening, if there are any questions, again, we always say this every week. Please make sure you're following us on all of our social platforms as well. You can message us all directly on there. And again, it's something that I always stress every week is follow Jenny on her on all her socials. There's content out there every day about what's happening on a daily basis, as well as what's happening in the industry as well. So great advice, Jenny, as always. Thank you for that.
Awesome.
So I'm going to talk a little bit more just about what has happened in January. 2 weeks ago, we spoke about what happened on Boxing Day with the biggest amount of properties going live onto Rightmove, with just over 10,000 properties in the UK going live on that property platform, which gave us a really good indication of what was going to happen potentially for the first quarter of this year. I think most agents are cautious about thinking too further, sort of forecasting longer than 90 days or 3 months, because anything can happen. We are already starting to see, again, that positivity, like you said earlier, about what's happening with the market. There's more mortgage inquiries coming in. So you're having to play around with the screens now.
I was having a play then. I was having a look to see what they did. I thought you was doing that. I'm going to have a look.
Oh, look, oh no, I'm too close there. Go back to that.
Look, hang on. Oh, look at that. It took control.
So yeah, we were looking, obviously, agents are a little bit more too reluctant about forecasting more than 3 months, only because, again, we have got things like the election coming up, but there are a lot of world events going on as well at the moment, which is just stabilizing things. So let's have a look at Lincoln. So what I've got this data from is I've gone on for Lincoln in January, and I've done a 15-mile radius, and I've excluded things like retirement homes, new build, and bits and pieces. I've tried to just look at the main focus of the residential market. Now, where we're looking at the figures of those, if you were to put a search in on Rightmove at the moment, there'll be 3,473 properties that are live at the moment. If you include solds in that, there's 5,037, which means there's 1,564 properties showing as sold subject to contract, which is a 31% conversion. That's quite a strong market for Lincoln at the moment. It's definitely better than what it was last year. It was at 19% at points last year. It's not where it was a few years ago when you're looking at 45%. But I have to stress as well, of the properties that are out there that are new, that are coming on, some of those will also be new price properties. But if you're going to look at, do buyers have a choice at the moment, and where is the market? Because I get asked this a lot. What's the market going to be like this year? Well, are you a buyer or are you a seller? Because it's two very different conversations. So if you can see, if you were a buyer out there at the moment with over, nearly 3,500 properties available across all price brackets, to be fair, there's a lot of choice. So you have got to be competitors, as we said, in regard to bringing the property to the market at the right price is the first thing. Okay. If I then have a look at, if you've got the biggest checkbook and big deep pockets with cash in it, what's the most exciting property you can go out there and buy at the moment? Well, there's an amazing investment if you are in the market to buy 126 properties and you want to buy all the student accommodation at Bishop Grot College up there. They've got all of their student accommodation available there, 126 properties, £9 million.
Oh,
so there we go. That's a bit of an opportunity. It just goes to show how much the student market is worth.
I think, students, HMOs, they're killing it at the moment, along with holiday lets as well, to be fair.
That's it. If you're looking at just, what's the grandest sort of residential property out there, there's a beautiful home over in Morton, and that's come to the market at 9 million. Sorry, that not 9 million, that was the resi one. That's 2 million, apologies.
2 million.
Just taking 7 million off that one.
That'd be grateful for that.
Yeah. So again, for Lincoln and Lincolnshire, a 2 million price sort of property is, it's a big number, that is.
Yeah, definitely.
Let's go to the other extremes. The cheapest, have a bit of a poke at it's an apartment. Have a bit of a think what you think that might come in out for me then, Jenny.
Go on. I think it's probably going to have quite a short lease. So I think it's going to be around 45,000. Go on, let's go.
You're not far. Well, this one's actually on at 65. Okay. And you're right, though, about lease affecting the values of properties. This one's got a reasonable length of lease on it, and I'll just point that. The reason for why that can affect value is if you've only got a 25 to 50-year lease left on it, the chances are that the mortgage lender is going to want you to extend that lease. They won't like lending on it. So it's good for investors or cash buyers. But if you've got something with a minimum of ideally 99 years, 75 to 99, even up to 125, it increases the value because it means you'll be able to resell the property on several times in the lifetime of that lease. There we go. So yeah, from 65 up to 2 million. What we're also seeing is the number of properties, the solds, as I say, we're seeing a big increase from where we were mid-year last year to where we are now. And as I say, of the ones that have just come on the market in the last 14 days, we've had 612 properties come to the market, and including sold 637. So there's what, 20 properties or so in there that have already sold in the last 14 days. That again says to me that people are starting to now bring the properties onto the market at a sensible asking price.
Yes.
What we were seeing last year is again, we've talked about this, properties were going on a little bit high, they were taking longer to sell. So if you pitch it at the right asking price, you have a better chance of selling within the first first 2 to 4 weeks. Realistically, the average at the moment in Lincoln is around about 6. The last 2 properties that I've sold have been on the market for about 5 weeks or so. So we're seeing a definite change in there. And again, it's in that price bracket. The highest properties, highest number of properties coming into the market are priced between 224 and about 285 at the moment. But that's what we want to see happening, because that's where the affordability is in the marketplace. And we know that if we can start seeing that marketplace move on, the next bracket, the 320 to 400 bracket, will have a knock on. And then we'll also then see that we'll the £500,000 properties upwards will start rolling on sort of 3 months down the line. So it's a really good indicator. Good properties coming on the market, a sensible amount now starting to sell, from anything, as I say, from a market of 19% right up now to that 31% for the whole of the Lincoln market. So a little bit more sensible, particularly where you compare that to one of the first shows we did when we were talking about what was happening in the flatlining of the marketplace, and that was only 4.5 months ago.
Yeah. That's crazy how the market has moved on. But that's confidence, because interest rates are coming down. So one starts to move, then the other starts to move. The neighbours board goes up, and it's like it just keeps flowing and flowing. And that's what we need. We need people to build that confidence. That gives the lenders confidence. It gives the buyers and the sellers confidence, and everything moves nicely.
The other thing I'm just going to touch on there as well is that I've often talked about A&E, the A&E department of a estate agency, which is attention and exposure. And I talk to a lot of the home sellers that I work with, and when I'm on appointments and when I'm talking to people, it's about, you've got to create the maximum amount of attention and exposure to get the best outcome from the sale of your property. Okay. Mm-hmm. The other thing I'm talking to people about at the moment is urgency. Is that we've got to create almost a little bit more of a sense of urgency, is that we've got to get people talking and offering on properties and giving a commitment to properties, and trying to put a little bit more control back to the home sellers as agents. Because, if people are just drifting around looking at, 15, 20, 25 properties, you've got a slim chance. You need to be working with an agent that can create that exposure to get them into the funnel and to get them viewing in the first place. And then we've really got to be pushing on in regard to creating that urgency to get deals tied up at the moment. Otherwise, again, properties are going to be going on the market, and they're going to take longer and longer and longer to sell again. So while this market is there, everybody needs to be moving forward to obviously make sure that we have the best start to the year as we possibly can.
Yeah, absolutely. And I think on that as well, Mike, buyers are getting smarter. So they will look on Rightmove and see exactly how long that property's been on there. And any offer they put will be reflected. Well, actually, it's been on the market for X amount of months or whatever. So we're gonna edge our bets at this, because they obviously can't sell it. So actually, a quick sale will probably mean more money in your pocket, I reckon, as well. Yeah. Do you agree or disagree?
Absolutely. Again, the amount of conversations when I've spoken to people who've sold quickly at a price and have turned the offer down, think, oh, I sold it too quick. And they will reject the offer. The buyer will then be going out the marketplace because they'll go and buy something else. Mm-hmm. You lose that buyer. Several weeks down the line, the home seller will be on the phone. Oh, I'm not getting much interest, etc., etc. They either then review the price and bring it down a bit, or next buyer comes along, and I can guarantee you they'll offer less than the first person who came along the first time round. Nearly always happens. The agent's got to work a lot harder. Not always, but the agent does have to work harder to try and get back up to that magic figure that the home seller was looking to achieve. But I've seen it countless times where the home seller ends up selling for less than the original first offer that came in as their first offer or within the first few weeks. As I've said before, take your opportunity when a buyer comes along. Just make sure your agent's working as hard as they possibly can and is working to get that best offer. But you've really got to look at that in the light of day. And we've said again, even a couple of weeks ago, Jenny, we keep doing this sliding scale thing. If you have to take $5,000 off yours, go and try and take $6,000 off the one that you're buying. I had a great example of this actually last week. I had an offer on one of my properties, and part of my service is that I also offer an onward purchase service where I'll not only sales progress that, but I'll also negotiate your onward purchase on your behalf for you, because I'm the salesperson and it's in my interest to get you the best outcome from the sale of your own property. But if I can help you on your onward purchase, and we agreed a magic figure that the home buyer was happy to pay, and we got it at a good price on what they wanted to do. So there was more money in their back pocket. So it's a win-win. They've got the best outcome from the sale. They've got the best outcome from their purchase. And ultimately, all homeowners were happy with that deal. And we also tied in some timescales in there as well. So real life story there is, agents negotiating on your onward purchase is it's a biggie as well.
Yeah, absolutely. And it keeps it all nice and neat. And it's that one point of contact, isn't it? Which, let's be fair, most people just want that one point of contact these days.
Yeah, definitely. So we've actually covered a lot there.
God, that was quite detailed for us, Mike, I have to say.
It was. I know. I need a coffee or a glass of wine now, don't I?
Yeah.
So actually, where are we at now? Nearly 7:30. Well, my evening's only just begun. I'm about going out now to go and do it. I've got a viewing and I'm going off to go and pick another set of keys up from a homeowner who's going to let me have some keys so I can go out again on another evening and do some viewings when they're at work. So agency, and well, I know you as well, Jenny. We send messages in the evening. This is where your social media posts go out. This definitely isn't us now starting to wind down for the evening. This is our nighttime shift now, isn't it?
It is, yeah. I will be working probably to about 10 o'clock tonight. So yeah, we shall see. So if you send me a message and it's like 10 o'clock at night, don't worry about it. I'm probably still working.
Very good. And then to be fair, you are often, responding to messages in an early morning as well.
There is that, yeah.
So again, thanks everybody. Again, plenty of people stuck by us this evening and watched the entire show, which again, from our point, we really, really do appreciate. Thank you very much indeed for your support. So again, if there's anything you want us to cover in next week's show, come back and let us know. If not, me and Jenny will be scratching our heads on Tuesday afternoon, wondering what we're going to talk about. But yeah, thanks for watching again, everybody. We've got some end of show credits to run out with you as well tonight. It's getting more and more like the one show. But thanks for watching. Follow us on our social medias. Make sure you like the page. Make sure you like our show today on your social medias. And we'll look forward to seeing you again next week.